You want to start? You want to get their attention?
Yeah.
Use the mic. So.
Good morning, everyone. I am not your professor, but I do have an announcement. My name's Derek Hagan. I'm the co-chair of Diversity Committee for Stern Student Government. How many of you are going to an Ally Week event? Just give me a hand raise. Yes, amazing. After I'm finished talking, you're all going to be raising your hands. Because Ally Week is amazing. It's March 4th through 8th. This is an annual week that we have of programming at Stern, sponsored by Student Government, Diversity Committee, OSE, and many of professional and affinity clubs. There are many amazing activities, including, as many of you know, Dr. Bryant Marks is coming to speak during your block time that Monday. There are several other workshops, and the focus is on allyship. Hop on board. If you would like to go to campus groups, any event that's under ESCOV that's tagged Ally Week, you should definitely sign up. They're all incredible and is a really great way to show up for the members of your community. So how many of you are going to Ally Week events? Everybody, that's right. Thank you.
So moving right along. You want me to ask you the question? No, I'm not going to ask you the question anymore. You kind of know the implicit question. By now you got your company, you got your risk-free rate nailed down, you got your equity risk premium done, right? Let's act under the delusion that we're there, right? Today we're going to put risk premiums to rest, and I'm going to actually use the updated numbers as a way of kind of reviewing what we did last class. So if you think about how we tried to estimate equity risk premiums, we started with a question, which is we want to know how much more than the risk-free rate investors are demanding for investing in equities as a class. And we gave three ways in which you could come up with that number. One is to ask people. Ask investors, ask portfolio managers, ask academics, ask analysts. The only problem with asking is people can say whatever they want. There's nothing behind the number. Second, we can look at history. We can look at the past. And for markets like the US, you think you have a lot of data. At least it looks like a lot of data. 90 years for most of us is a lifetime for a human being. So that's a lot of data. But unfortunately, in terms of stock market history, 90 years is not quite enough because you still get very noisy estimates. And we looked at a forward-looking dynamic premium, which is just a fancy way of computing a yield to maturity on the stock market. That's basically what we did. So if you remember, I left you with this page where I computed the implied equity risk premium at the start of 2019 to be 5.96%, reflecting the fact that the market's at 25, what you paid for stocks, 25.06 on that day, the expected cash flows, the growth rate. Are there assumptions here? Yes, just like in historical premiums. I could be wrong about growth rates. I could be wrong about cash flows. There's a standard error on this 5.96%, just like there is on the historical premium. But you know how much the standard error is going to be? It's going to be about 0.2 or 0.3%. So I'm not going to make the claim that this is a perfect estimate because there are assumptions behind it, but it's going to be a more precise estimate than a backward-looking premium. And it's dynamic. It'll change on a day-to-day basis. Now, you've probably been reading, like I have, about how the market is in a bubble, stocks are at an all-time high. And there is an element of truth to that. Stocks have gone up for a decade. We've had this great bull market. And the longer a market lasts, the more worried people become about, hey, has it gotten too high? When is the correction coming? And there are some investors out there who claim that the bubble is here and the market's going to burst at any point in time. There's no way you can convince them otherwise, but when you hear a statement like that, you say, how do I know whether stocks overall are overvalued or undervalued? I'll give you the metric I find most useful. This equity risk premium is the premium as of the start of 2019, right? When you tell me stocks are too high, what you're effectively telling me is the equity risk premium you're earning is too low. Let me give you a graph to kind of illustrate this. This is the implied equity risk premium, the number that I computed in 2019 going all the way back to 1960 for the S&P 500. So you look at the 1960s, you see an incredibly stable risk premium. The US was the center of the universe, and essentially the risk premium for the US was between 3 and 3.5%. Then you get in the 1970s and something clearly is starting to shake loose, right? Look at what's happening to the equity risk premium in the 1970s? It's climbing. Let me pause right there. If the equity risk premium is climbing, what's happening to stock prices? They're going down. Just like interest rates go up, bond prices go down. When you demand a higher risk premium, the only way you can earn that premium is by paying less for stocks. And the 1970s were a horrible decade for stocks. In fact, by 1978, stocks, the Dow was at 770. Three numbers in the Dow. Think about it. It's at 26,000 now. It was 770. Clearly something went wrong in the 70s, right? So what was the reason for risk premiums climbing so much in the 70s? What is the precipitating factor? Want to try? What is it? Inflation. And why, as equity investors, are you so scared of inflation? Why is inflation? I mean, I know inflation affects bondholders, right? Because clearly, with bondholders, you set an interest rate, inflation goes up, you're hurt. The conventional wisdom with equity is, with inflation, you should be okay because you're an equity investor. You should pass it through. Why does high inflation hurt equity investors? One is businesses get scared, right? We act like businesses are completely flexible. The problem with high inflation is not that just it's high, but it's volatile, right? When inflation becomes 10%, it's almost never certainly 10%. It could be 4, it could be 16. What it starts to do, it affects whether companies invest for the long term. In fact, as inflation rises to 20, 25, 30, 50%, don't be surprised if all long-term investing comes to a standstill, because nobody wants to bet on a long-term investment and be wrong about inflation. Inflation is 4 times more deadly for stocks than it is for bonds. Risk premiums climbed to 6.5% in 1978. People were telling you not to buy stocks, that equities were now dead. Wrong advice, because the next 20 years you got one of the great bull markets of all time. And the way you see this is the risk premium keeps dropping and dropping and dropping. There are a few blips along the way. But by the end of 1999, the peak of the dot-com boom, the implied equity risk premium in the US was down to 2%. To gain some perspective on the 2%, remember that survey that I did last week where I asked you how much? I think there was somebody, one person, if you're sitting in the same place, you know, who is a person here who said they'd take a 2% premium? Okay, 2% premium. There's only one person in this class who would have been okay with a 2% premium. What were the rest of you telling me then? 2% is not enough for me, right? When you tell me the risk premium is too low, what are you telling me about stock prices? They're too high. You know what the definition of a bubble is? Is when the implied premium is 2%, but you think you can make 6 or 8%. That's delusional. But that's what a bubble is. When people buy stocks and price in a 2% premium and sit back and think they're going to make a 6% premium. That bubble, of course, burst, and over the next 3 years, premiums went back to 4%. They kind of stayed around 4% for 5 years. Then in 2008, they went up to, you remember the jump in 2009 in the last quarter, to almost 6.5% again. And since 2009, here's what I've seen. Equity risk premiums have stayed high, and they've become much more volatile. Welcome to the new globalized economic order. Because in a sense, if you think about what's happening now, everybody's crisis is everybody else's crisis. Expect risk premiums to be much more volatile. I've gotten here in a circular route, but the question I started with is, how do we know whether stocks are too high? Are they in a bubble? If I wanted to reframe that question in terms of risk premiums, what am I asking? In 1999, were stocks in a bubble? I could have given a pretty good case about stocks being in a bubble and used what is my evidence? That the equity risk premium had dropped to 2%, it was too low, and it had to go up. The equity risk premium at the start of 2019 was 5.96%. If you look at the history, that number is not low. It's actually towards the higher end of the scale. Now, something could blow up on us. The buyback portion could disappear. The risk-free rate could climb. So I could tell you a story where markets would correct. But that story needs a lot of pieces to it. You can't just say, stocks have gone up, therefore we're in a bubble, because that's a very sloppy way of defining a bubble. So whenever I hear talk of there's a bubble, there's a correction, what I do is I go back to the equity risk premium and check for myself whether the numbers have imploded. And they could. So it becomes a catch-all number that you can focus on to answer the question, do I think stocks are too high? Do I think stocks are too low? What should I do about stocks overall? So start of 2019, my implied premium was 5.96%. Remember last session I came up with a country risk picture that you saw as of November of 2013? I'm going to update that to the start of 2019. So let me review again how I came up with the numbers for the start of this year across the world. I started with the S&P 500. Why again? It's not because I'm being parochial, but because I have more access to the numbers with the S&P 500 than with any other index. I came up with 5.96%. That became my base premium. I checked your rating as a country. If you had Moody's rating, if you didn't have a Moody's rating, I went to S&P. And that gives me ratings for about 150 to 160 countries. I take that rating, and if your rating is AAA, I give you the same risk premium as the US, 5.96%. If your rating is not AAA, then I look up a default spread for your country using either the government bond, if you have a dollar-denominated bond, the sovereign CDS spread, but in most countries just the rating because you can't even find the first two. I come up with a default spread. Remember how I scaled the default spread up for how risky equities were in that country versus the government bond? I used to try to do it, but I very quickly would run out of ammunition because there are only about 20 or 25 countries where government bonds are even traded. And I need it for 160 countries, so I cheat. And here's how I cheat. Rather than compute it for each country, I compute one relative risk measure across the world. And to do that, I look at two numbers. I look at the standard deviation of an emerging market equity index that S&P has. So you can go to the Federal Reserve. They actually have these numbers going back daily, weekly, monthly. I look at the standard deviation in emerging market equities collectively. Then I look at the standard deviation in emerging market government bonds. It's another index that S&P has. And then I look at the ratio of those two numbers. Start of 2019, that ratio was 1.23. Collectively around the world, emerging market equities were 1.23 times more risky than emerging market bonds. And I apply that 1.23 to every country. It's sloppy, but it gets me there. Because it now allows me to take the default spread for every country and come up with a country risk premium. I add it on to the US premium, and I come up with an equity risk premium for every country. So here's what the world looks like to me at the start of 2019. So it's very similar to what you saw in November of 2013, but it reflects the much higher equity risk premium that you have in the US. It's 5.96 rather than 5.5. So you're going to see the 5.96 in every country with the AAA rating. And the ratings are now updated to reflect 2019 ratings. So the risk premiums around the world. The only thing that I've added to this table that you did not see in November of 2013 is you go look at the top right-hand corner. There's a separate box of countries that I don't seem to have put in regionally. You say, what's different about those countries? Take a look at that list and you'll very quickly see what's different about them. They include countries like North Korea, Syria, countries which do not have a rating. And until 2017, I used to not have a rating. Therefore, I would say, look, I can't estimate a country risk premium, no equity risk premium. So my risk premiums would not have those countries. But I've added that because you might invest in those countries for whatever reason. And I've had to cheat to get those numbers. To get those risk premiums, here's what I had to do. There's a service in Europe called Political Risk Services. It actually puts a country risk score to a country. And it has country risk scores for countries like Syria and North Korea. I looked up the country risk score for Syria. Let's say it's 38. The scores go from low to high, high being really safe countries. I think Switzerland is 92, Sudan is 29. So I look up the risk score for your country. Then I look for other countries with risk scores just like yours. For Syria, there are 4 other countries with risk scores around 38, 36, 40. 2 of those countries had ratings, and I'd estimated a risk premium for those countries. So I took the average of those 2 countries, and I attached it to Syria. It's not the most scientific and sophisticated way of doing it, but if you can come up with a better way, I'm willing to listen. But now I have risk premiums for pretty much any part of the world you might choose to operate. And remember, you need this even if you never plan to analyze a Syrian company. Is anybody doing a Syrian company? Are there Syrian companies? I don't even know. Okay? But remember, if your company has exposure to a country, you have to know what the risk premium is to be able to analyze that company. Any questions about equity risk premiums in general? So this does require that you've already picked a company. So as I said, there'll be implicit ways I nag you, explicit ways I nag you. Think of this as an implicit nag. So take your company, look for the geographical breakdown of its revenues. Right? It'll be somewhere in the annual report. Most of these companies will break down only revenues. Don't look a gift horse in the mouth. Take the revenues and run with it. In fact, if you're given a breakdown of revenues and EBITDA, I would still go with the revenue breakdown because the EBITDA breakdown can be affected by accounting allocations. If you have a natural resource company and they give you breakdown by production, you can use that instead. Or if you want to use both, you're free to do that as well. And don't expect clarity. Many companies have very opaque ways of breaking down revenues. You've got to live with the data you have, not with the data you wished you had. So do whatever you need to do to kind of come up with an equity risk premium, even if it means taking shortcuts to get to that number. So that's the end game on equity risk premiums. It's not just where a company is incorporated, where it does business, and for that you need the risk premiums by country. Let's now move to the third and final input. So let's review. When I ask you what risk-free rate are you going to use, it will depend on what currency you've chosen to do your analysis in. When I ask you what risk premium you're going to have for your company, you're going to look at where it does business and build up a risk premium. There's one final input we need to get a hurdle rate. I need a beta. And if you remember your first finance class, we're all taught to estimate betas exactly the same. We're asked to run a regression of returns in the stock against returns in a market index. The slope of the line is the beta. Okay? In fact, magically that line becomes, a fact. The beta that you get from the regression becomes the beta used in analysis. I'm going to make a strong argument against using that beta, but let's take a look at the rest of the regression, because often we take the beta out of the regression, we throw the rest of the regression out. So you run a regression of returns in your stock against returns in a market index. You got the slope, it's a beta. There are two other pieces of output in that regression that I think are relevant in corporate finance. The first is the intercept of the regression. I'm going to argue, and I'll back it up, that the intercept you get in a regression tells you something about whether your stock was a good investment or a bad investment during the period of the regression. Let me repeat that because there's a key word there. Whether your stock was a good investment, not will be. So it's a post-mortem. So over the last 2 years, if the last 5 years, say, was my company a good investment? By looking at the intercept, I'll be able to back into an answer and say, hey, your stock was a great investment, an average investment, or a bad one. And the third piece of output from a regression, and this goes back to statistics, is any time I run a regression, you look at the R-squared. In statistics classes, R-squareds become measures of goodness of fit. So in statistics classes, what are you taught? You want to get as high an R-squared as possible. When you run beta regressions, don't play that game, because the R-squared is what it is, and in fact, it carries some economic power. Remember when we talked about risk, we said there are two types of risk in a company. Risk that you can diversify away, which is risk specific to the company or a few companies, and risk that you cannot diversify away, which affects most or all companies. The R-squared tells you the proportion of the risk in your stock that falls into the second category. The R-squared tells you how your stock moves with the market. So if you have a high R-squared, most of your risk in your company comes from macroeconomic factors and market risk. If you have a low R-squared, most of your risk comes from the company. You're saying, is that relevant in investing? I'm going to put you on the spot in a little while. When I show you the R-squared for the beta, for the Disney regression, there, what should I do with this? But for the moment, file that away. So the slope tells you how risky your stock is. The intercept tells you how good or bad an investment your stock was during the period of the regression. And the R-squared tells you where the risk in your company comes from. Now in the abstract, the regression looks like a given, right? Returns in the stock against returns in a market index. But let's take a look at each of these other pieces of output to see why they matter. When I run a regression and I get an intercept, so in this case I take returns in the stock against returns in the market. The returns in the stock is your dependent variable. The return in the market is your independent variable. You run the regression, you get the slope. You get also the intercept. To see why that intercept gives you something of value, let me go back to the model for which beta is supposed to work, right, the CAPM. And in the CAPM, if you remember, the expected return on a stock is equal to the risk-free rate plus beta times RM minus RF. Let's do some algebra. Let me move some terms around. I promise I haven't messed the equation up. But I can actually rewrite the CAPM as the risk-free rate times 1 minus beta plus beta times RM. You say, why are you wasting your time? Why do you even do that? Just hang in there. So basically, if I rewrite the CAPM, the return on a stock should be the risk-free rate times 1 minus beta plus beta times RM. Now think about what I ran in the regression. Returns on the stock against is equal to intercept plus beta times RM. Compare the two equations. If my stock did exactly as predicted during the period of the regression, here's what I should expect to see. The intercept I get from the regression should be roughly equal to the risk-free rate times 1 minus beta. Think of the risk-free rate as times 1 minus beta as what the intercept should have been if the stock had done exactly as predicted. So if I have a stock that has done incredibly well over the last 5 years and I run a regression, here's where it'll show up. My intercept is going to be much, much, much higher than what I get by taking the risk-free rate times 1 minus beta. So I'm going to run the regression, I'm going to get the intercept, and then I'm going to compare the intercept to the risk-free rate over the period times 1 minus beta. And if the intercept is much greater, I'm going to tell you your stock did better than expected. If it's much lower, it did worse than expected. In fact, I'm going to take the difference between the intercept and the risk-free rate times 1 minus beta, and I'm going to call it an alpha. In fact, I'm going to call it Jensen's alpha. And there's a history behind that term. Michael Jensen was at the University of Chicago in the 1960s. He was part of the group of people who actually created finance as a discipline. In the late 60s, he decided to look at a question that everybody seemed to know the answer to already, which is, do professional money managers do better than the market? The presumption then was, if you have mutual funds that are run by professional managers, they must beat the market. Otherwise, why would you pay these guys? So the presumption was, we're paying these guys, they know a lot about the market, they must beat the market. There were 125 mutual funds. This was a much smaller market at that time. He said, is that true? Do mutual funds beat the market? So he looked at the alpha, basically used this approach to look at mutual funds. And what was he expecting to see? He was expecting to see the intercept you would get for the mutual funds to be much higher than the risk-free rate times 1 minus beta, that they earned more than they should have. What he discovered remains one of the most enduring findings in finance, which is when you look collectively at mutual funds, their Jensen's alpha, does anybody want to give me a guess? Did he find a positive number or a negative number? He found it negative. It would be greater or zero. It was actually minus 1.5%. Why minus 1.5%? Let's say collectively mutual funds deliver what the market delivers. It should be 0%, right? But then you have expenses, you have fees, etc. By the time you net them out, he came up with, it's the strangest profession. I've never understood it. The analogy I would offer, it's like starting a plumbing business called Floods or Us. And here's what I do. You have a leak in your house, I come in and leave a flood, and you pay me. We do this every single year. So Jensen's alpha reflects that history of that's where it was born, and we now use it for individual stocks. It's become more sophisticated, but it's still the same process. We compute the actual return a portfolio manager makes. We look at what the portfolio manager should have made given the risk they took on, and we compare those two numbers. We come up with the Jensen's alpha. So we're going to do this at the company level, but you can do this at the portfolio level as well. So the intercept is going to tell us something about performance, but only when you compare to the risk-free rate times 1 minus beta. And finally, let's talk about estimation processes. When I talk about running a regression of returns in the stock against returns in a market index, what I'm not telling you is I have lots of estimation choices to make. Like what? Let's take Disney. If I wanted to estimate a beta for Disney, I could go back all the way to the 1950s. The stock has been traded for more than 60 years. I could run a regression over the last 62 years. That's good, right? I'll have more data. But here's the trade-off. I could go all the way back to 1956 and run a regression. I'll have more data, but what's the price I'm going to pay? Disney in 1956 was a company that didn't even have a theme park open. Disneyland hadn't opened. It made one animated movie every 3 years. And the beta that I'm getting for Disney today will reflect the company it used to be, not the company it is today. So the trade-off is you have companies that might have been listed 80, 100 years, but using all the data will give you a beta that's actually not right for the company as it exists today. I don't think any service that I know of goes more than 5 years back. So some services use 5 years. Bloomberg's default is 2 years. 2 to 5 is pretty much the standard estimation period, even for companies that have been listed 100 years. At the other end of the spectrum, if you've got a stock that went public 6 months ago or a year ago, you don't even have this choice, right? You can use only 6 months or a year of data. There you don't have to pick between a year or 50 years, but for some companies you have to make that choice. Second, let's say I decide to go back 5 years. Why? Because I like 5. I have a second choice to make. I can take 5 years of returns and look at every day, daily returns, which will give me about 1,250 observations, because there are about 250 trading days a year. I can take 5 years of data and break them down into monthly returns, which will give me 60 months. I can take 5 years and divide weekly returns, which will give me 260 observations. And in today's day and age, because data is broken down by minute or hour, I can take hourly data and make that 5 years into thousands of observations. Again, if you think purely in terms of numbers, it looks like I should go with daily or even hourly data because I'll get more data, right? But here's the trade-off again. As I start to slice the data finer and finer, I run into a problem if my stock does not trade continuously. This might not be an issue with Disney, but if I took a less liquid stock, I'm going to get periods where there's no trading and it's going to throw my beta off. In fact, studies show consistently that daily returns are not a very good way of estimating betas because for lots of companies, the trading is not continuous enough for the beta to reflect the risk. That's why if you look at services, services either use weekly data, Bloomberg uses weekly, or some services use monthly data. Bloomberg has to use weekly. You know why? What did I say they go back? How many years do they go back? 2 years. So if you have 2 years, you can't use monthly because you have only 24 observations, so they go weekly in 2 years. So when you see a Bloomberg beta, and you're going to see it in a little while, it's the reported beta, it's based on 2 years of weekly returns. So you have to decide how far back to go, how to slice up the data, and I'm not done. What did I say the regression was? Returns on your stock against returns on a market index, right? Just take the US. You know how many market indices there are out there? Let's start with the best known. You have the Dow 30. So when people talk about the market, often they're talking about the Dow 30. Index that's been around since the 1870s, or more than a century. You got the S&P 500, which is the 500 largest market cap stocks in the US in proportion to their market values. It's a market cap weighted index. You got the NYSE Composite, which is stocks listed on the New York Stock Exchange. And there was a point in time where the NYSE was the end game for every company, so every large company would be in there. Then there was the NASDAQ, which used to be the side index, but as more and more big tech companies have stayed on, you got the NASDAQ now have substantial market cap. And that's just the beginning. You'll have the Russell 5000, the Wilshire. You could, I think, last time I counted 125 different market indices just in the US. And if you go global, you could have 500 different indices. You're saying, so what? When I run a regression, the beta that I get will be very different for my stock as I start to change indices. In fact, on a Bloomberg terminal, you can actually change the index and see your beta change. So I'm going to ask you a kind of general question. I have these indices in front of me, 125 different indices. Which index should I pick to estimate my beta? Let's take Microsoft. Let's say Google, right? It's listed on the NASDAQ. I could run a regression of Google against the NASDAQ using the rationale. It's listed on the NASDAQ, so I'm going to use that index. I can run a regression of Google against the S&P 500, one of the 500 largest market cap companies. I could run a regression of Google against the Wilshire 5000 because it is all stocks, the S&P. So I have a list of different indices. What's my tiebreaker? How do I decide which index is the best one? It goes back to the CAPM, right? This is all in service of the CAPM. And in the CAPM, what did we all end up holding? Remember, no transactions cost and now private information. And what was in the market portfolio? Everything. The closer you get to that vision, the better your beta is going to be. So let me go through the list of indices I already listed, and you tell me why the index will work or will not. Should I use the Dow 30? And if not, why not? No, because only 30 stocks. And you know what? Most indices you're going to find outside the US will look more like the Dow 30 than the S&P 500. The DAX is only 30 stocks, the CAC. You go across Europe, every index is 25, 30, 35 stocks. The Sensex, 50 stocks. So first problem with the Dow is it's too small. Could I go with the, why not the NASDAQ? It's now got a lot of stocks, and it's the Google is listed on the NASDAQ, so why shouldn't I use the NASDAQ? It's really a tech index. It's not a market index, right? So running a regression against a tech index is not capturing the vision of a marginal investor who's diversified. So I can't use the NASDAQ. The NYSE has a problem because it's a price weighted, it's a strangely constructed index. Almost by default, if you look at US indices, you see how people back into the S&P 500. The S&P 500 might be only 500 companies, but you know what their saving grace is? Because they're the 500 largest market cap companies as a percentage of all stocks, they're close to 80% of the overall market value. So even though it might not be an index that has every single traded stock, but the S&P 500 still has one handicap that we haven't overcome. It's only US stocks. When I talked about the CAPM and I talked about the market portfolio, notice I drew no borders. I said every single traded stock. The end game here, and one of these days this is going to happen, is we should be estimating betas for every company, wherever it is in the world, against some global index that is actually a good global index. In fact, the most widely used global index now is called the MSCI. It's been used a long time, but it's an immensely flawed index. But one of these days you're going to see an index come up that you can actually use. But for the moment, you still have this very parochial process where we estimate betas against the S&P 500 for US companies, against CAC for French companies, DAX for German companies, and you're going to see this play out in some strange looking betas for companies. Okay. But if you're thinking about what the right index is, that's the way to think through it. And as investors, and the marginal investor becomes critical, right? 20 years ago, your marginal investor might have been a domestic institutional investor. Today, you look at your marginal investor, wherever you're in the world, odds are BlackRock is somewhere there. You have global investors pushing more and more into companies around the world. I think we're reaching a point where we have to start to think about risk as risk added to that global portfolio. Yes?
This is purely out of ignorance, but what is the limitation of making global or at least a whole US?
It's not that there is a limitation, but that people don't create indices unless they think there's a market, because people don't create indices out of the goodness of their heart, right? The S&P creates indices because it actually makes them money. There are ETFs created in the indices. So what will drive the process is somebody starting a global ETF saying, I want something better than the MSCI. Right now, they're okay with the MSCI because it's a marketing device. They build an index, say, look, I have a global index that matches the MSCI. Nobody's sitting there saying, how can I create an index so people can get better betas? That's not even in the top 20 list of what they want to do. So unfortunately, because people don't think of it as critical enough, it'll happen, but it'll happen on its own time. But it's not difficult to create. You could do it yourself, right? I have 43,000 stocks. I could create a global index, but then I'll have to maintain it every minute of every day. This is a full-time job for some service to do. And that's the problem, is you need an S&P or somebody with who has the ammunition to consistently update the index and keep it going for it to work. So, yeah. I think so. But clearly global advisors like the MSCI. You know why? Because I told you it was flawed. When you have a flawed index, what does it help you do? Look like you can beat it by just taking advantage. For instance, the MSCI used to be overweighted in Japan, and every advisor knew it. So they knew exactly how they could look like they were beating the index. They took its weakest link and they essentially... So that's the reason advisors really don't want you to know the truth. They don't want to know the truth, to be quite honest. I mean, who wants to be telling themselves, I'm not creating value? But eventually I think it will come out, but it's going to come out, on its own time. Yes? The flaws of the MSCI, the weightings reflect market values at the start of a point. It looks only at big companies. I mean, if you look at the MSCI, it's not a true global index where you're taking equities in every market. It's bigger stocks in every market. Most of them have ADRs. So you're getting a subset of global stocks. So it's nice to have the MSCI, but if you look at the MSCI's performance and then you create your own performance measure using the actual stocks in every market, the MSCI return will not match up to what you get by looking at the composite return across stocks. And when the MSCI was created, their defense was, many of these stocks are not traded. It's tough to get the information. We can't build a global index with all traded stocks because the information is not there. That excuse is now gone. So, I mean, it's not like people are not trying. And they're trying because there are ETFs out there that would like a true global index, right? Because for them, that becomes critical. Because they'd like you to be able to trade global equities and actually mean it, not just trade MSCI. Yeah. So that's my third choice. What index am I going to use? And then there's a final choice I have to make. So let's say I've chosen a period. I've chosen daily, weekly, monthly. I've chosen an index. Here's my final decision. And this is really a decision I shouldn't have to pick between because there's one right answer, but you'll see why some people might go with the sloppier answer. What do I need? I need returns on my stock by period, right? By day or by week or by month. What are the two ways you make money on a stock as you hold it? First, you get dividends, and the second is you get a price change. So let's say I do things on a daily basis. Do you get dividends every day? So most days you get only price change, and every 3 months or so there is this one big day, an ex-dividend day, where you get a dividend. It's a pain in the neck to bring in dividends because the price changes are already in your computer. You can just say, okay, run a regression. But bringing in dividends takes work because you've got to find the ex-dividend day, you've got to put the dividend, you've got to figure out what it is. So a lot of services, when they talk about returns, run regressions with just the price change. Not because it's the right thing to do, but because it's easier to do. But in reality, your return should include dividends, but only, so don't try to be fair and spread it out across time. It doesn't work that way. If you don't own stock on the ex-dividend day, you don't get the dividend. So basically, you've got to find the ex-dividend and put it in there. So let's look at these choices for Disney and let's see how it would play out. So for Disney, here's what I decided. I decided to go back 5 years and use monthly returns. I just like 5-year monthly returns. I think it gives you better estimates of beta. And if you can get it, might as well use it. So I used 5 years of monthly returns. I stayed with the S&P 500, at least for the initial regression. And for every month, I computed returns on Disney by taking the change in price and looking to see if there was a dividend that month. And if there was a dividend, putting it into that month. So you're going to see in my regressions 4 months of every year where there's a dividend and 8 months where it's only price change. But I didn't just stop there. If I do this for Disney, I also should do it for the index, right? And the index, it's not one day because different stocks pay dividends in every day. I had to collect dividends by month. And now you can already see why services take the sloppy route. It's again not difficult to get the data. But for the index, here's what I did. I took the index at the start of the month, the index at the end of the month, checked to see what the dividends were collectively on the index and added to the return each month. So every month I get returns on Disney and I get returns on the S&P 500. Yes?
Wouldn't new service providers like Bloomberg, when you collect this data, wouldn't they provide the data assuming reinvesting the dividend?
No, don't ever let them make the assumption for you because you don't want the dividends rolling over because your return, you want to count the dividend in there. Most services, when they report on the index, report the post-dividend. So basically, they just report the price change. You can, on Bloomberg, check the dividend. The data is there, but you have to explicitly look for it. Because they can't assume reinvestment. Why? Because people might not reinvest. So it's not right for them to assume reinvestment, but if you wanted to get the data, it's there, but you have to go looking for the data. Okay? So I get the returns every month. So think of this as an Excel spreadsheet. At this point, what will I have? I have 5 years of data, monthly data. I have 60 months of prices and 59 months of returns. Why did I lose a month? What do I need to get a return? I need a price change, right? So as I go from month 1 to month 2, month 1 I'll have no return because it's a starting month. So first month of return, so I'll have 59 months of returns in Disney and 59 months of returns in the index. Now we're going to run a regression, right? But remember your statistics. Before you run a regression, what are you asked to do? Visualize the data, which is a fancy way of saying do a scatter plot. Scatter plot's not fancy. You take returns on the stock on one axis, returns on the market on the other, and you take every month. So see those blue points? There should be 59 blue points. If you want to count, you're welcome to. But basically I've plotted the 59 blue points. So every month is a blue point. So what are we trying to do when we run a regression? We want the best fit line, right, through those blue points. Saying, how the heck am I going to do it? Don't sit there with the ruler saying, this looks good, this looks better. In fact, in statistics, how do we get the best fit line when you run a regression? What do? We minimize the squared distances from the line. That's why it's called ordinary least squares. Don't worry, you don't have to know how to do it anymore. A package will do it for you. But remember, that's exactly what's happening in the background when you do a best fit line, is you're minimizing the squared distances. And thank God for regression packages that do it for you, or Excel will do it for you. See that line? That's your best fit line. And when you get a best fit line, if you run a regression, you get the output. And here's what the output looked like on this regression. The intercept was 0.0071. File that away because remember, we're going to use that intercept to get a measure of whether Disney was a good or a bad investment over the 5 years. The slope of the line was 1.25. If you want to be precise, 1.2517. What's that going to be? That is my estimate of the beta for the stock. What's the thing in brackets, 0.10, below the 1.2517? The standard error, because I want to be honest about what I'm telling you. I'm giving you a beta, but I'm saying, wait, before you use it, remember there's a range around the beta, and the standard error is 0.10. And the R squared of the regression is almost 74%. So let's take this regression apart and see what we can learn about Disney between 2008 and 2013. Between 2008 and 2013, the intercept I got from running that regression was 0.71%. And the question I'm asking is that a good number or a bad number? And to make that judgment, I have to compare that number to the risk-free rate times 1 minus beta. And here I've got to get into the weeds. My regression was run using monthly returns, right? So my intercept is a monthly return intercept. You're saying, so what? The risk-free rate I should then use has to be a monthly risk-free rate. When you look up the T-bond or the T-bill rate online, it's always annualized. So when you see a 0.51% is the 3-month T-bill rate, you're not going to make 0.51% over the 3 months. It's a 0.51%. So all rates as you read them are annualized rates. I've got to convert them back to something I can use. So I'm going to be very sloppy. I'm going to take the average risk-free rate over those 5 years, which is 0.5% a month. I'm sorry, annualized 0.5%, and I'm going to divide by 12. The reason that's not quite precise, I should be taking a compound, but it's not worth it. With the risk-free rates being what they are, I'm not going to get much precision by doing it. So my monthly risk-free rate is about 0.04%. First, I want to make sure, do you see why I'm using a monthly risk-free rate? If I'd used weekly returns to run my regression, at this point, what should I be doing? I'd be dividing by 52. Use daily returns. It's actually messy. You're not sure whether to divide by 365 or 250. Do whatever works for you because it's going to be pretty close to 0 anyway. But your risk-free rate should match up the tenor of your regression. So in this case, it's 0.04% a month. I'm going to multiply the 0.04% by 1 minus the beta. Remember, I got the beta already from the regression. The beta is 1.25. So 0.04% times 1 minus 1.25 gives me minus 0.01%. You see, what does that even mean? I'll give you the best intuitive hook I can give you for that number. If Disney had performed exactly as predicted by the CAPM between 2008 and 2013, the intercept you should have seen in this regression should have been minus 0.01%. That's what you should have seen. What you actually saw was 0.71%. The difference between those two numbers, 0.72%, is my measure of Jensen's alpha for this company. And before you say 0.72%, who cares? That's per month. Every month for almost 60 months, I made 0.72% more than I needed to. Now, I know monthly returns, our minds don't quite grasp the magnitude of the number. So let me help you by making this a more substantive number. If I make 0.72% every month for 12 months, on an annualized basis, and here I'm going to do the compounding because 7.2% is a pretty, 0.72 is a pretty substantial number, and I go up. I made 9% more than I needed to. Here's what I'm saying. I'm not saying Disney made 9.02% a year. I'm saying Disney made 9.02% more than it needed to. So if you have a stock with a beta of 2, and the market is up 20%, what does the stock need to make? Forget about, let's say the risk-free rate is close to 0. Market's up 20%, your stock has a beta of 2. For this stock to break even, what return does it have to make? It has to make plus 40%. If the market's up 20%, it's got to be twice as much. When I say the Jensen's alpha is 9.02%, you know what I'm saying? It made 40% plus 9.0. It's pure gravy. It's a risk-adjusted, market-adjusted measure of performance. So we can spin this around. Is there a standard error in the 9.02%? Absolutely. But I guarantee you, even if we bring the standard error, it's not going to drop to below 0. So we can debate whether the Jensen's alpha was really 5 or 15 because the beta could be off. But clearly, Disney did better than expected between 2008 and 2013. You're saying why? That's what the rest of the semester we're going to look at. What did they do between 2008 and 2013 that delivered that alpha? But let's take the Jensen's alpha, and I'm going to dig a little deeper. Okay? Let's assume I did this calculation for every single stock in the market. Did what I did for Disney, okay? Computed Jensen's alpha. What should the average Jensen's alpha be across all stocks, roughly? You see why it has to be 0? What did I say Jensen's alpha was? It's how much your stock beat the market. Collectively, stocks can't beat themselves. That'd be a strange number to say. Collectively, stocks did 7% more better than stocks. So the average Jensen's alpha across all stocks has to be 0%. So if I told you that the Jensen's alpha for, let's say, Amazon over the last 5 years has been close to 70%, and it has. That's good news, right? But if the average Jensen's alpha is 0% for every Amazon, what does there have to be? An anti-Amazon. And you could put a name on that company. It could be GE, it could be Kraft Heinz. For every positive Jensen's alpha, there is this other side that because we tend to focus on winners, because that's what we read about. But remember, for every winner in this game, there's a loser. Okay? So the reason I bring that up is often people have regrets. Because when I told you the Jensen's alpha for Amazon was plus 70%, what was your regret? I wish I'd bought Amazon 5 years ago. And this is something that can eat away at you, because you see a stock go up, NVIDIA. Say, I wish I'd bought that stock. Before you spend too much of your time and energy regretting not buying Amazon, you know what you should be celebrating? Not buying GE, right? Life's too short for regrets. You're going to miss some winners, but be glad you did not load up on the losers. Jensen's alpha is a post-mortem. It's not telling you should buy Amazon today. It's too late. But it's saying, look, I wish I'd bought Amazon, and then you let it go. So the average Jensen's alpha across all stocks is 0%. Now I'm going to switch roles. I'm going to be Bob Iger. It's 2014, and you're my stockholders. And I get up, and I'm very proud of what I've delivered. And I should be, right? 9.02% Jensen's alpha. I say, look, I've done a good job for you. Not only has your stock gone up, it's gone up more than it should have. You're one of the winners. And this is where I'm expecting some compensation. I said, look, I deserve a bonus for doing that. So really the question I'm asking is, when you see a company with a positive Jensen's alpha like Disney, does that mean the management of that company did a good job? Why not?
Because this is against market index. Probably all
Well, I beat the market index. That's all I can do, right? I can't beat some absolutes. I did better than the market. Isn't that what you hired me to do? Okay, so now we're on to something. Because when you look at the positive Jensen's alpha, it's a function of what you did as a company. It's also a function of how your sector did that period. I mean, I'll give you a classic example. You know the average Jensen's alpha for all oil stocks is negative over the last 5 years? Every single one of them. And before you start dumping on the managers of these companies, what explains why the Jensen's alpha is negative? 5 years ago, the oil price was $100 a barrel. Today, it's $60 a barrel. When you're fighting headwinds that strong, your sector is going to have negative Jensen's alphas. So to make a judgment on whether management at Disney was responsible for it, what should I do next time? I should be computing the Jensen's alpha for all entertainment companies or all or whatever I define to be the peer group. And let's say that average Jensen's alpha is 15%. I should probably be firing you for delivering on. It sounds greedy, but you got to think about how much of performance is delivered by management and how much is coming from being in the right place at the right time. Conversely, if you have a negative Jensen's alpha, before you fire the management, you have to look at, is this a sector-wide problem? Because you can have a bank that has a negative Jensen's alpha of -3%, but if the rest of the sector is at -10, you're still a winner. So the Jensen's alpha for your company is the start of the assessment, but it cannot be the end. And finally, I've kind of given away the answer. You have a positive Jensen's alpha going back over the last 5 years. Let's say I'm a stock picker, I'm an investor. Should I be, at the end of the semester, I'm going to give you the Jensen's alpha for all 400 of your companies, or you're going to give me the number and I'm going to pass it back to you. If you wanted, you could invest in all the stocks that had positive Jensen's alphas. Is that a good investment strategy, to pick companies that have been winners in the past and load your portfolio with them? I would love to say no or yes, but here are the two forces in investing. There's the momentum force. What does it mean? Winners can often continue to be winners. And there's a contrarian force, which is at some point in time, winners hit a wall and fall out. In the short term, guess which wins? Momentum wins. That's why if you look at portfolio managers and you look at what's in their portfolio, they're always picking stocks that have done well in the last 6 months, because their game is, what can I pick? Sometimes they run into that wall within that 6-month period. But in the long term, contrarian wins, which means if you want a 5-year portfolio, my advice, and this is very perverse advice, is to pick all the stocks among your 400 stocks that had big negative Jensen's alphas, and don't let anybody see your portfolio. They'll be horrified at what you have in there, because you're going to have the GEs and the Kraft Heinzes, the stocks that everybody is dumping on, and then you go away for 5 years, don't even check your portfolio. And you come back, maybe 20% of the stocks will have gone bankrupt. That's okay. But 20% of your stocks will have made a full recovery, and you'd have made 400 or 500%. And if history is any guide, you're better off investing in stocks with negative Jensen's alphas going forward if you have a long enough time horizon. But that's investment advice. I'm not going to give you that investment advice. But I'm saying be careful about not jumping too quickly based on the Jensen's alpha, because it's a purely backward-looking number. It's a post-mortem. So any questions on Jensen's alphas? Yes?
Sort of the LB's effect in there. You are assuming the market really priced it correctly. It could just be that the price is...
I'm assuming nothing, right? Basically, when you say price, where is it? Because when I talk about buying winners or losers, I'm actually assuming the market is not pricing it correctly. That in fact there's an overreaction in markets, that stocks that have done well collect these people who jump on the bandwagon. They keep pushing the price up way above. So in fact, I'm giving you a story of market inefficiency. If this were an efficient market, Jensen's alpha should have no predictive power. Winners and losers should do equally well. And that would have been the safe place for me to leave you, but I think the data suggests otherwise. That there is this leakage in the market, and especially with index funds and ETFs becoming so much a part of the game, momentum becomes an even bigger force. Do you see why? Because if you're let's say the Vanguard 500 index fund, and the Facebook goes up 30%, you got to kind of stay with that because you're a market-weighted index. So momentum has become a very strong force that you cannot ignore. But riding momentum has its own risks as well, which is this correction might come, at which point momentum and everything else is wiped out. So that's the Jensen's alpha, and comes from looking at the intercept. Let's look at the regression. Slope of the line is 1.25. That's my beta, right? And if I were a data service and I wanted to give you the illusion that I deal in facts, not in estimates, I'll even tell you the beta is 1.2517 because it makes it look like I know the beta to the 4th decimal point. But let's do some statistics. I gave you the standard error in the beta estimate to be 0.10. The regression beta was 1.25. Remember in statistics we come up with confidence intervals? Let's suppose I asked you to give me a range for Disney's beta with 67% confidence, which is not a whole lot of confidence. You're going to be wrong 1/3 of the time. But with 67% confidence, what's the range on Disney's beta? It's going to be 67% is usually plus or minus 1 standard error, which would give me a range of 1.15 to 1.35, plus or minus 1 standard. If I asked you for 95% confidence, that's 2 standard errors. The range for Disney's beta would be 1.05 to 1.45. And Disney has a fairly low standard error. If you take a stock like GoPro or any young tech company, your standard errors can be 0.3, 0.35, 0.4. Think of the range that you get in the beta. So you can look up a regression beta, but remember it comes with a range. So for better or worse, when you estimate regression betas, remember you're not getting a fact, you're getting an estimate. You can come up with a range on that estimate. If you're being honest with me, that's the range you should be giving me. So here's what I call the dirty secret of beta estimation that services will never tell you. That when a beta is estimated, it comes with a standard error. And remember the 0.10 that I showed you for Disney? That's at the low end of the spectrum. The median standard error for a beta estimate in the US is between 0.2 and 0.25, which means if I tell you the beta for Coca-Cola is 1.1, what I'm truly telling you is the beta is somewhere between 0.6 and 1.6. I'm going to give away the game. I'm progressively going to chip away at regression betas because I think they're a terrible way to estimate betas. And I've just delivered my first reason why. A regression beta is noisy. It comes with a range. And that range is going to be so wide that often it's useless. So you can have a regression beta, but because the range is so wide, you don't know what to do. Let's complete this process by looking at the R-square. The R-square tells you what percentage of the risk in a stock comes from the market. And whatever is not R-squared is what comes from the firm. So for Disney, those numbers were 73% from the market, 27% from the firm. And if you're diversified, which part goes away? The 73 or the 27? You'd like it to be the 73, but unfortunately it's going to be the 27. And there is actually a very interesting trend, something that's happened since 2008 that I've been tracking through the R-squares. If you look at pre-2008, the average R-squared for US companies was about 25 to 30%. In 2008 and 9, that number jumped to about 65% collectively. And it stayed much higher than historical since then. So something happened in 2008. Pre-2008, more of the risk in a stock was firm-specific. Post-2008, more of it has become market risk. And you can see this in your portfolio, right? When one stock goes down, you get much more market-wide movements. Why do you think that's happened, and what are the implications for investors? Sorry? One could be indexing. You could argue, because they're always easy to blame, right? The indices did it. So indices could be part of the problem. What else?
Fewer large companies now contribute to the larger market cap.
That could be the Facebooks, the Google, the Amazons account for a big chunk of the market. So maybe those 4 stocks move together. That's going to push everything up. But the R-squares then for the rest of the stocks should actually be not. So those 4 stocks can account for the market. But why are the R-squares of the other stocks so dependent on these 4? It could be.
Larger marginal investors.
It could be that global investors are now driving the game and they're basically pricing risk the same way. So it could explain why R-squares around the globe are kind of converging. And it could also be that this is one of those things that comes out of globalization, that we are all now connected. I know globalization is an easy thing to blame as well, but the reality is, again, companies cannot operate. I mean, if you go back 30 years, companies used to operate in the local markets, and the rest of the world went to hell in a handbasket. If all you sold were cupcakes to in the US. You say, who cares what Turkey is doing, or Argentina is doing, or Brazil is doing? And the macro factors seem to be pushing R squared up. But it has implications for investors. Let's say you're a value investor. You try to pick stocks. Which part of this equation are you trying to make money on? The R squared part or the 1 minus R squared part? You're trying to make money on the firm-specific component, right? The 1 minus R squared part. And pre-2008, what did I say? It was 70 to 75% of a stock's variation. Do you see why stock picking just got a lot more difficult? And people have been complaining about this for 10 years, but the underlying reason is the R squareds have gone up. Here's the slightly good news. In 2016, the R squareds peaked. And in 2017 and 18 in the US, you've seen the R squared start to drift back. They're not to pre-2008 levels again, but you're starting to see firm-specific risk come back. And that's good news if you're a stock picker. So the R squared is a number you get out of a regression, and whether you use it or not will depend on what kind of investor you are. So I'm going to frame a question for you. Let's assume that I come to you with two stocks, Disney and Amgen, and you can pick only one of the two. They have exactly the same beta, but Disney's R squared is 73%, and Amgen's R squared is 25%, and you're a diversified investor. Which of these two stocks would you invest in and why? The low R squared stock, the high R squared stock, or you don't care? You're a diversified investor. Yes? Okay, let's say that you've done the valuations, already implicitly telling me what kind of diversified investor you are, right? So if you're an index fund, you would never diversify. And if you're an index fund, you're probably going to say, I really don't care which one I buy, because when I'm done, what's going to happen is the firm-specific risk is going to go away. So if you're a diversified investor who doesn't try to do valuation, you're going to say, I don't care. I'm going to pick either stock. They're going to give me the same amount of benefit because the beta measures that, and the firm-specific risk will go away. But if you're a stock picker, a value investor, a Fidelity Magellan, which in theory at least tries to pick stocks, you might say, look, I want to go with the low R squared stock because there's a greater chance my analyst might find something that's not priced in right. So if you're a diversified investor, whether you look at R squared will depend on whether you're a passive diversified investor or an active diversified investor. But let's change the facts a little bit. Let's suppose that you're now talking to your eccentric uncle. You're sitting next to him at Thanksgiving. You can't escape. He says, I hear you're getting an MBA. I want some investment advice. And he tells you his investment philosophy. He says, I don't trust these mutual fund guys. They will steal you blind. I buy only 3 stocks. And don't try to sell me on this diversification thing. I've heard it from my financial advisor. I don't buy it. It's a conspiracy. I buy only 3 stocks. If you're advising your uncle and you want him to do well, because I want to make sure that I have clarity on your objectives. Maybe you want him to go bankrupt and you're going to give him advice to make him go bankrupt. If you're not diversified and you're going to hold only 3 or 4 stocks, do you want stocks which have high R squareds or low R squareds? I'm sorry, what?
Depends on the risk aversion.
Well, let's take any given risk aversion, whatever risk aversion you have, assuming you are risk averse, low risk aversion or high risk aversion, assuming you're risk averse, you should go with a high R squared. Do you see why? Because if you put your money in 3 low R squared stocks, what's the price you're paying? Remember, what's not R squared doesn't get rewarded. You're not the market. You put your money in stocks that are incredibly risky, and even if you're a stock picker, you're exposed to this immense risk you're not going to get rewarded for. So you're saying, how can I be a stock picker and own only 3 stocks? You cannot. And that's something to remember when people make these stupid arguments for, should I be diversified or should I pick stocks? As if they're mutually exclusive. You can pick stocks and be diversified at the same time. What am I telling you? Don't put all your money in 3 stocks. Put it in 23. You might not do it overnight, but over time you have to build up that diversification, because then you can at least get the benefits of the averaging out work for you while you're picking stocks. So R squared might not tell you much as an investor if you're a diversified passive investor, but it might tell you where to put your money if you're not diversified or you're an active investor. So until about 2002 or so, when I taught this class, everybody had to run their own regressions. Not difficult to do, because to run the regression, then what do you need? You need to collect prices for 60 months. You need to collect dividends over those 60 months. And you can do this. Yahoo Finance has it. So if you want to run your own regression, try it out. It's not difficult to do. You put it in an Excel spreadsheet, convert them into returns. It's a good exercise. But I'm going to give you a shortcut that all of you can use. You don't have to run your own regressions. And you got to thank Bloomberg for it. And don't thank them too much, because they don't give those terminals for free. Each of those terminals costs us about $50,000. So your time is being recorded, and you'll be sent a bill when you graduate. Right? So if you go to Bloomberg, find your company. And that might be a bit of a task, because some of your companies have 7 listings. You might have to find the actual listing. And once you find your listing and you type in the word beta, this page will pop up. So in 2014, I decided to do this for Disney, because I've already run the Excel regression. I said, have a Bloomberg, let's see whether we get the same answer. So I went to Bloomberg, I pulled up the beta page for Disney. And initially, the beta page it showed me was 2 years of weekly returns, right? Because that's a default. But the nice thing about a Bloomberg beta page is it lets me change the parameters. So here's the first thing I changed. I made the 2 years into 5 years by choosing the starting point to be September of 2008. I changed the weekly to monthly because that's what I'd run. So now I have a regression that should be exactly like mine, right? It's 5 years, monthly returns, Disney against the S&P 500. So what I was hoping and praying was the numbers I got in my Excel would match up to what Bloomberg came up with. So if you want to go back 5 pages to my regression where I had the scatter plot, you can compare the numbers. Let's start with the raw beta. What did I come up with, do you remember? 1.2517. They came up with 1.247. I can live with that. It's within noise. In fact, if I round up, it's 1.25. So thank you. We're on the same beta. The intercept they came up with, I'll come back to the adjusted beta, was 0.60%. Bloomberg is extremely sloppy about percentages and decimals. So that 0.599 is not 59.9%. That would be great if you're looking at a Jensen's alpha, but it's 0.60%. What did I get as my intercept? 0.71%. And for about a decade when I first got the Bloomberg, I'd struggle with this difference, because the intercept I would get, the betas would be pretty much the same, but the intercept was slightly different. And here's the reason. When Bloomberg runs their beta regressions, they run it using just price changes. They do not include dividends. Why? Because the computer is running it. The data is there. Dividends are a pain in the neck. And their defense is most people use these regressions to get what number? The beta. So the beta is not that affected. So this is so much of a pain, we're going to ignore dividends. It works in most companies, but if I gave you a real estate investment trust or a bank, you can see how dangerous this can be. Why? Why did I pick real estate investment trusts and banks? What do they do? They pay big dividends. If I ignore the dividends, I'm kind of missing a chunk of returns that actually stabilizes my returns. My beta is going to be too high for those stocks because I'm missing something that makes them more stable. But to the extent that it's free, it's easily accessible, it saves you time, I'm going to let you use this beta regression and accept the fact that the intercept you're going to get is going to be slightly off. 0.60% versus 0.72% or 0.71%. The R squared they got was 73%, which I think was pretty much what I got as my R squared as well. The standard error is 0.099. So the numbers are pretty close, which leaves me with one unexplained number. You're saying, what is that adjusted beta? The adjusted beta, and this is going to sound incredibly convoluted, but hang in there, is 2/3 times the raw beta plus 1/3 times 1. You're saying, what? If your raw beta is 1.8, your adjusted beta will become 1.53. If your raw beta is 1.5, your adjusted beta will become 1.33. If the raw beta is 0.6, the adjusted beta will become 0.73. You're saying, why? What am I doing with all my raw betas? I'm pushing them towards 1. What's so magical about 1? It's the average beta for the market. I'm trying to be helpful. I'm telling you, your company will probably get bigger over time and more diversified over time, and therefore I'm going to move the beta towards 1 for you. To which your response is, please stop helping. Because the weights I use, 0.67 and 0.33, must be magical weights. Because Bloomberg uses exactly the same weights for all 40,000 companies it reports betas for. I could ask you where those weights come from, but it wouldn't be fair. I didn't know the answer to the question. I tried asking Bloomberg, but they didn't know either. It's amazing, it's a number sometimes go in and nobody knows. I don't know, it was here when I got here. So I did my digging. I found the original source. It was a paper written in 1971, 47 years ago, by a guy called Marshall Bloom. And here's what he did. He took 100 stocks. You're saying, why only 100 stocks? In those days, you actually hand-collected data that acted like a natural cap on how many stocks you wanted to collect data for. He took 100 stocks, and he estimated the betas every year, 1961, 1962, 1963. And he broke the stocks down based on how high or low their betas were at the start of the period. And he tracked what happened to their betas as they moved through time. And guess what he found? They tend to move towards 1 with a shrinkage factor, statistically, that's how quickly they moved, of roughly 2/3, 0.67 and 0.33. That was 1971. You think, how did that get into a Bloomberg estimate? The first beta estimation service was started by a guy called Bar Rosenberg, who was a professor at Berkeley, who actually was the editor of the journal where this article was published, Journal of Finance. And when he started Barra, the way he looked for ideas is, let me look at papers that have been published. So Barra, when it started, used the shrinkage factor from the 71 paper. And that shrinkage factor has taken on a life of its own, and today it's used all over. Nobody has any idea where it came from. But my point is, that was 1971. Do betas move towards 1? Yes. Do I know which direction 1 is? I hope so. If I want to get from 1.8 to 1, could I get there? Yeah, you go 1.7, 1.6, 1.5, 1.4. I don't see the point of somebody holding your hand and say, let me tell you which direction 1 is. That's all this number is giving you. I completely ignore the adjusted beta. I start with the raw beta, and if I have a company where I feel the company is diversifying, moving into broader businesses, guess what? I move the beta towards 1, and I control the process. In contrast, if I have a company that stays in its core business and is told us it will stay in the core business, I have no problems leaving the beta where it is. So when you look at this regression, take the raw beta, ignore the adjusted beta, move on to the rest of the process. So now let's bring all of these different numbers we've talked about for the last 30, 50, 80 slides together. Remember the end game, we've forgotten by now, right? We wanted a hurdle rate. I think I'm ready to do this now. I want a hurdle rate in November of 2013. And to get a hurdle rate, I needed a risk-free rate. The risk-free rate, I used the UST bond rate. Why? Not because it's a US company, but because I'm choosing to analyze Disney in US dollars, right? 2.75% becomes my risk-free rate. Second, I wanted an equity risk premium. The equity risk premium I had for Disney was 5.76%. If you remember, that's a weighted average based on where they do business. And for the beta, I'm going to use a regression beta for the moment, though I don't particularly trust that number, 1.25. Let's bring those three numbers together. Risk-free rate plus beta times risk premium gives me 9.95%. You do this ad nauseum in finance class, risk-free rate plus beta. We tend to forget what it even means. So I'm going to try to put some meat on this number. So basically, does everybody clear on the mechanics? Risk-free rate plus beta times risk premium. So the 5.76% is what you earn over and above the risk-free rate. It's what's in the brackets, 9.95%. So let me take you back to November of 2013. You're all potential investors in Disney. And I'm going to read a couple of statements about the 9.95%. You tell me whether this is a fair way of describing the number. 9.95% is the return that I can expect to make in the long term on Disney, assuming Disney is correctly priced and the CAPM is the right model for risk. How many qualifiers did I put into that statement? Let me go through. Expected. Don't come to me and tell me why didn't I make it. Expect to, it doesn't mean you'll actually make it. In the long term, so don't do it in 1 year, come back in 10 years. If the stock is correctly priced, if it's mispriced, all bets are off, and the CAPM is the right model for risk. I'm a very lazy person. I would not add this many qualifiers unless I actually wanted to make the statement true. This is technically a true statement. But it's kind of an arid statement, right? Because basically it says, if I lived in a market which was efficient, everything was correctly priced, and the CAPM was the right model for risk, if I wanted to make a higher return, what would I need to do? Buy a higher beta investment. If I want to make a lower return, lower beta investment. So I'm going to give you a statement that I prefer as a way of describing the 9.95%. It's a return I need to make on Disney to break even on my investment. Suddenly I've become a very needy person. What's the risk-free rate when I did this? 2.75%. Why didn't I just settle for 2.75? What do I need to make more than 2.75%? Remember the definition of risk? Danger plus opportunity. To get me to expose myself to danger, what did you have to offer me? Opportunity. If I wanted to make 2.75%, I'd buy the T-bond, but I bought Disney, I'm exposed to danger, I need to get that extra return to compensate for the danger. The reason I like that is it allows me to make it an action number, and here's why. I don't believe in efficient markets. My other class is a valuation class. The very moment I start to teach the class, I'm implicitly or explicitly telling you I don't believe that everything trades at its fair value, because otherwise I'd just open up the journal and say class is done. Yeah, there's your stock, there's your price, let's move on, right? So here's why the 9.95% works for me. Let's say I decide to do my own research on Disney. I collect data on the company, I do analyses, and I come up based on my analysis with a conclusion that I can make 12.5% a year for the next 5 years investing in Disney. This is based on my research. What do I need to make? 9.95%. If I think I can make 12.5% on an investment, and I need to make only 9.95%, what does that make Disney to me? A buy or a sell? Buy. I've never understood equity research analysts who are proud about the fact that they don't get this CAPM stuff. Okay, you don't get the CAPM stuff. He said, but I just pick stocks. How the hell do you pick stocks without a benchmark to compare it to? If you open an equity research report, there'll be a price today and a target price in 5 years or 3 years. I've never understood what I'm supposed to do with it. So let's say the price today is 50 and the target price in 5 years is 75. I should be thankful it's higher than today's price, but that's a pretty low threshold, right? What do I need to figure out? I need to figure out, if you go from 50 to 75, what return I will make on the stock. But then to decide whether the stock is a good stock or a bad stock, I have to compare it to something. The CAPM doesn't tell you what to buy and what to sell. It just gives you a benchmark. It doesn't stop you from picking stocks. It actually helps you pick stocks by bringing in that other side of the equation. But let me switch roles again. So as potential investors, what have you told me? That you need to make 9.95%, not even to be happy, just to break even. Let's say I'm now CFO of Disney. What is this 9.95% to me as a CFO? If that's what you need to make on your equity investment, that is my cost of equity. We make cost of equity into the abstraction. The cost of equity is what I need to deliver to equity investors to keep them on board, not even to keep them happy. Which means if I want to create value for you and you have equity invest in my company, the return on equity I generate from that equity you invest in the company has to be higher than 9.95%, right? So when I look at projects, collectively the return equity on those projects has to be higher than what you need to make. I know it's accounting money, it might be long term, but if I factor all of that, my job, once I know the cost of equity, is to deliver more. But there is an implicit assumption when you use this cost of equity that might as well be made explicit. And I'll tell you an anecdote to bring this home. It will be the last thing for today. So about 15 years ago, I was sitting across the table from the CFO of a very large Asian company. So out of the blue he says, what do you think my cost of equity is? I said, I don't know, maybe 11, 12%, because I knew what country he was in or know what business he was in. He said, it's not. I said, if you already knew, why the hell are you asking me? He said, it's only 2%. You know what he was measuring as his cost of equity? No, it wasn't the risk-free rate. What's the only explicit cost you have when you raise equity? Dividends. He was looking at his dividend yield. And by that measure, Google's cost of equity is 0, right? But let's not even go there. Let's stick with it. So how do you explain the difference between the 11% you get in the CAPM and the 2% dividend yield? What's the extra 9% for? It's price appreciation. Nobody buys equity just to get a 2% dividend. If that's all they wanted, they'd go buy bonds. So I tried to explain to him, you have to deliver price appreciation, at least on an expected basis. And then he asked me a question that initially floored me. He said, what if I don't? Do you see where I was going? When you borrow money and you have a stated interest rate of 8%, you don't pay the 8%, what happens? you go bankrupt. He said, what if I raise equity and you think you're going to make 11% and I tell you can make 11% and I deliver only 2%? So tell him what will happen. Your stock price will drop. He said, I don't care. I don't plan to raise equity. I don't need to go to the market. So hit him with the final bid. What happens if your stock price falls? What should the manager be afraid will happen to him? I said, you get fired. He started laughing. He said, do you see the last name on my nameplate? Do you see the name on the company? Do you see they're the same? What was he saying? There is no corporate governance here. What I'm trying to say is when corporate governance is weak, companies view equity almost as free capital, because what are you going to do to them? And this was actually what almost destroyed Japanese companies in the 1980s and 90s. They thought their cost of equity is 1 or 2%. They took projects that made 2.5% and claimed to be creating value. Eventually it caught up with them. But my point is the reason we spend so much time on corporate governance is whether you view the 9.95% as your cost of equity will depend on, do you as shareholders have the power to punish people for not delivering? Because if you don't, this is an abstraction. Okay? So keep that in mind. When you, what I'd like you to do is print off the regression, the Bloomberg beta for your company, the page that you saw, and I'll send you the directions for doing it, and try to do what I did for Disney for your stock. And this is good practice for your quiz. And I hate to be the bearer of bad news, but we are moving closer and closer. It's a week from next Monday, so you have lots of time. But this might be one of the first things you should do, is print off the Bloomberg beta and work through the numbers.
Looking into the futures trade of, let's say, Russian RTSI stock, RTSI futures index. And what I see is a big spike in the morning at the opening. So I was thinking,
Spike up or spike down?
oh, it depends. You never
So
know.
volatility in the morning. There's a lot of trading in the morning.
Volatility in the morning.
People closing out positions.
Right.
also,
So
yeah.
it's basically impossible to jump in and have a position the first minute because you're always late.
Yeah.
And I was thinking
So before you do that, what are you trying to do in the futures market? Are you trying to hedge? Are you trying to speculate? What are you trying to do? So you want to do intraday speculation. You know the reason you're having trouble is you're playing a loser's game, right? The big players have an advantage over you because intraday speculation is all about timing.
so I don't have the fast.
You don't have the computer, you don't have and especially in the Russian market because it's not the most transparent market in the world. God only knows how trades are routed through, who gets first trades. For all you know, you are 17th on the line and the 16 preferred customers get their trades done first.
Totally.
Yeah.
So I was thinking if I
Bought it the previous night, but you'd have to guess which direction the spike is. So you're now exposed to a different kind of speculation. So that might be actually a more potentially value-creating strategy. Rather than bet intraday, you're betting on whether the start of the day change is. So to do that, what you should do then is look at history and see whether there's a way in which you can predict the next day's spike. Right?
say I look at the
Is it based on the previous day? Is it a lagged effect on some stocks? Just make it a data analysis, right? They might show up. It might even, in fact, don't even just look at prices. Look at trading volume. On days after big trading volume is a spike up. So there might be data that you can then use to do the spike, and then you trade ahead of the spike. But be very clear that you're bringing very little to the table here, right? Because in a sense, but that's. Yeah, but that's basically what you're trying to do then, is take advantage of that. Spike.
and would you say that data can be
Don't even worry, because when you're trading in